Good afternoon. Okay, today I want to cover kind of three different things. In terms of my background, I originally trained as an engineer, but spent my kind of early part of my career in investments. And after a while, I sort of hankered to do something else and went to start a software business, which did quite well in the end, and went to float on the stock market about 5 years ago. And I stopped running that business probably about 3 years ago. And I kind of felt that, robotics and artificial intelligence were on the cusp of really sort of transforming the world, and wanted to get more involved. So I started off investing a personal portfolio in the area, and the more I got into it, the more I found that actually a more sort of structured fund product was needed to allow kind of generalist investors to get access to this sort of very exciting investment growth theme, which is quite hard to get in just sort of general investing. So I've been running the British Robotics Seed Fund for about the last 3 years, and it's been a really sort of interesting journey, seeing all of these kind of companies that are sort of potentially forming our futures, and getting under the skin and understanding them. So what I wanted to do today was to, first of all, just from the perspective of having been involved with some of these sort of businesses and entrepreneurs who are really progressive and thinking about what the sort of world of the next decade is going to look like, to share some sort of observations of, some of the things I'm seeing and some of the direction that the economy appears to be going in with that in mind. And then I'll talk more specifically about investing in tax-efficient schemes under the Enterprise Investment Scheme and the Seed Enterprise Investment Scheme, which are good ways of getting involved with early-stage companies that potentially have the potential for huge growth within an attractive tax-efficient wrapper. And then finally, I'll talk a little bit about the fund that I specifically run. So in terms of kind of some themes we're seeing for the world ahead, I guess first of all, there doesn't appear to be much evidence that kind of long-run deflationary, stagflation, low kind of growth environment is going to change dramatically in the immediate future, and sort of fixed interest returns, certainly in my perspective, are likely to stay very, very low. So the need to be in sort of equities and actually to take some risk is going to have to be a sort of key element of sort of capital growth in a portfolio. I guess the second interesting thing is that the amount of automation and productivity initiatives and technology which are sort of coming into the economy means that large organizations will need to employ significantly less people than they historically have done. So you see big US technology companies with a fraction of the headcount of a more traditional long-standing business. And I think you will see that in particularly sectors that have been large employers of late. So for example, the logistics industry or farming, they'll be able to operate on much reduced levels of labour. And so potentially one exciting investment theme is to think about how some of these industries which historically have borne very, very high direct labour costs might be able to become a lot more profitable through the adoption of automation and kind of the new range of technologies that are coming online. The kind of spin-off for that is, though, that most of the kind of expansion of the economy and the creativity in the economy is very much likely to come from innovative young businesses. And actually, certainly in this country, we're just seeing the pool of small businesses grow dramatically, kind of all the time, and it's a fertile ground for innovation. And I think the world of the future is a world where the economy is kind of significantly broader than it historically has been, and within this sort of broad range of businesses will be the sort of growing grounds of industries and types of businesses that we probably can't imagine at the moment. But I suspect that kind of rate of innovation and the brains that will go into kind of creating the world of the future will really operate in that environment. And actually, therein is the breeding ground for growth in a portfolio. I think also that all the evidence suggests that public services are continually becoming kind of more strained, and so the pressure, to reduce the scope of public services and certainly increase sort of taxes and potentially reduce the tax incentives for investing will all continue to play out. So certainly as I look at it, the state of the forthcoming decade is likely to tax a bit higher and make it less attractive to get sort of tax advantages through investment than it is at the moment. So in terms of just specific company opportunities from that, I think one of the interesting things is looking at the way that private sector operators can come up with very sort of low cost formats that potentially substitute the need for relying on historically sort of state provided services. And that might be in things like elderly care or medicine. I suspect there's a kind of a layer of service provision which will be affordably low cost but will sit outside the sort of remit of kind of free state-provided services, and I think that's quite an interesting area to keep an eye on. In terms of the kind of tax incentives that are provided at the moment for investment, obviously, people are encouraged to save into a pension. However, we're already seeing the generosity of pension-based investing go down quite significantly, and whilst there's benefits on the inbound side, there's still significant amounts of tax to be paid on the withdrawal side of things. We've obviously got ISAs, again. Kind of quite mature, no inbound benefits, but good on the outbound tax side of things. And then there's another kind of class of tax breaks, which is probably less well known or understood, which is EIS and SEIS funds, so Enterprise Investment Scheme and Seed Enterprise Investment Scheme, which really are kind of medium to long-term type investments, but there are significant tax incentives on the inbound side of things, so an investor is able to get significant reductions in their tax, which is effectively funded by the government, and also quite significant outbound tax benefits. However, the quid pro quo is that these investments typically have to go into investments which are less liquid, so they need to be held for a longer period of time, and typically have to be sort of held for that period. However, if they're put into a fund format, a reasonable amount of that company's specific risk can be mitigated simply by holding a sort of broad portfolio of different companies, and significant returns across the fund's portfolio can be realised, and consequently, the opportunity to get significantly higher level of return for that risky end of the portfolio than might be available in sort of typical quoted equities. And so specifically what we do at the British Robotics Fund is really scout around for the most exciting robotics, artificial intelligence, machine learning businesses which are really driving this new generation of growth in the economy, and try and put together a kind of balanced portfolio of companies within that landscape. So, I mean, robotics is moving into almost every area of the economy, whether it be agriculture or logistics, domestic robotics, manufacturing. And so we try and find companies which are operating across that whole range of industry sectors, and also companies which are doing different types of things, whether they actually might be creating a robot or they might be a supplier to robotics companies. So we're getting exposure across the whole range of that industry. Obviously, the companies themselves are sort of high growth in their own right, but they carry risk. And so we try and manage the risk by obviously making sure that they are getting these significant tax breaks under particularly the SEIS scheme, so that effectively the government is underwriting 60 to 70% of an investor's investment. And also by providing a kind of comprehensive mentoring and support service for the companies. So particularly using my background as someone who has sort of floated a company, helping the companies really think about how they can build their business to a point where it can deliver significant returns back to investors. Typically under the schemes, the holding has to be in place for at least 3 years to qualify for the tax benefits, but then thereafter it's possible to start to get returns as the companies are either sold or float, or one's sort of share portfolio is sold onto a secondary buyer. So we've already seen just in the general world significant exits from some of these robotics companies, and it's certainly our expectation that in the decade ahead, it will be possible to generate very, very significant company sales for these kind of early stage robotics companies as they become a more significant part of the economy. So really, the fund's remit is to balance the risk for the investors, but look for some of these, potentially economy-changing businesses that can go on and deliver very, very significant returns in the years ahead. So by all means, do come and speak to me afterwards if it's an area that's interesting for you. Thank you very much.